right. Welcome, everyone. We'll get started in just a minute while we go live on all the platforms. Thank you for tuning in early. It is February 7th, just after 11 a.m., and we're about to go live here in just a minute. There we go. Looks like we're live on YouTube and some other platforms. Just give us a few minutes for the stream to start everywhere, and we'll get started in just a minute. Good morning. Good morning. Hello, Jason and Elisa. Hello, Maria. All right, we'll get started here in just a minute. Takes us about 2 minutes to go live on all of the platforms. And it looks like we're ready to go. Thanks, everybody, for tuning in early. Let me get started. Welcome, everyone. My name is Nick Hiersche. I'm the president and founder of the Mortgage Calculator. We are a lender that specializes in non-QM mortgage loans and alternative income documentation, as well as conventional FHA, VA, USDA, all of these standard programs as well. So I'd like to thank everybody for joining us this morning. We also have our team members, Jose Gonzalez, our sales manager with 27 years of experience. He will go through a detailed example here once I go through the live rates this morning. And we have our COO, Kyle Hiersche, who will explain how to connect with our team to get your own detailed quote. So I'd like to thank everybody for joining us. Again, it is February 7th, just after 11 a.m. So all of our rates are live on all of our loan programs. So I'll pull up our live rates here in a second. First, let me introduce the topic we will go into detail here, which today's topic for the show is going to be on hard money mortgage loans. Very common request. A lot of different opinions and misconceptions a lot of times. So hopefully Jose can kind of set that straight, give us some straight to the point options with some real rate quotes that he just pulled this morning from some of our actual hard money lender options. So this will be great. Hard money mortgages, Jose will explain in more detail, but that's basically asset-based lending, right? So we're going to lend based on a property, based on the property value, without really looking at the borrower's credit and income and anything else like that. These are the traditional commercial mortgages that most people are used to. They've been around for quite a while and is also known as asset-based lending. So we'll go through those details here in a minute. But first, as we do every morning, let me get into the live rates. So let me pull up my tool here so we can get started. All right, so this is our live pricing tool. This is for our mortgage professionals. So again, this is just going to indicate the pricing for today on all of our mortgage programs. It is February 7th, so this is just the price for today. We love to watch as we fluctuate through the markets to see what generally the markets are doing for our programs. So we're licensed in 17 different states for primary and secondary mortgage loans. And we can also do our business purpose DSCR loans, which we love to do. We'll talk about a little bit later in most states as well. So let's pull up some basic examples here so we can check out what the basic market is doing. And we're going to go through primary home first. We'll go through a conforming conventional example. We'll then pull up our FHA example, which is usually the second option for a borrower who may not quite meet the conforming guidelines. Then we'll pull up our non-QM expanded guidelines programs. That's where we love to shine as the mortgage calculator, where we can have thousands of other options for borrowers who may not quite fit conforming or FHA. We will not do VA today. That is a program that is only for our veterans. So if you do qualify, that's amazing. We appreciate you. And we'll quote that up in just a couple minutes. Since not everybody qualifies, please get with our team. They'll quote that up very quickly. And same with USDA. That's for rural properties only. Please get with our team. They'll quote that up if you're looking in a rural area. We'll focus on these 3 examples, and we'll go through some investment property examples as well. So we'll start with our basic scenario that we'll pull through every day. Always going to be a 80 LTV loan, so 80% loan, 20% down payment. We're always going to look at one discount point in price. With the market the way it is right now, most borrowers are requesting a little bit of a buy down to improve their rate, and they'll usually finance that with some sort of seller credit or other concession. We're always going to check out a purchase 30-year fix, so everything's going to be a pretty standard loan scenario. We're going to do primary, single family, 1 unit, and Florida, Miami-Dade, since that's where our office is based. And for all of our scenarios today, we use 760 estimated FICO and 40 estimated debt to income ratio. So this will be our setup for all of our examples today. And let's check out what our live rates are today on our conventional programs. All right, as we do every morning, these first ones that pop up are kind of the specialty ones. So these home ready and home possible options are great, but they are for our borrowers that do qualify under an area median income. So let's cruise down the list to find our best option that is the standard program. So we can talk about that. Looks like the best option today is this standard conventional program, 6.375 rate for 1 discount point in cost. So briefly last week, we saw rates dip below 6% for the first time in a long time. And today it's up a little bit. So that's why we love to do the show, so we can watch it over time. And please always pay attention to the APR here so that you can compare across these programs. Now, if a borrower does not qualify for conforming or conventional, typically the next option that we're going to go to is an FHA program. So let's pull up the same scenario and check out our FHA rates this morning. FHA does allow us to go a little bit higher on the DTI and some other guidelines as well. So typically that's the next best option. Everything else is going to stay the same. Purchase, 30-year fixed, primary, 1 unit, Florida, 760 credit, and 40 DTI, even though we can go higher. That way we can compare apples to apples here. And for our FHA programs, looks like this morning the best option the computer found here was a 5.5% rate for 0.875 in discount points. So that's kind of the best combo we found. And keep in mind to compare the APR. APR is a little bit higher typically on FHA because we have monthly mortgage insurance and upfront mortgage insurance typically. So always compare that so that you can compare apples to apples across the programs. Now let me get to the exciting part. So here at the Mortgage Calculator, we specialize in non-QM or alternative financing programs, and those pop up under our expanded guidelines options. So many banks and other lenders do not have some of these options. So this is where we love to shine. There's thousands of loan programs once we click this option that go beyond our conforming and our FHA to offer us all kinds of leeway on the different guidelines. So when we click this option, we'll keep everything else the same, but we'll notice a new option pops up for income verification. So we can still do a full doc loan, but there are thousands of other programs. When we go 1-year alt doc, 2-year alt doc, we can do asset related programs. We did an episode a couple weeks ago on that. Business bank statement, 12, 24 months, very popular. Investor DSCR, we'll talk about that in a second for our investment purchase. And personal bank statement, 12 and 24 months, also probably the most popular, and a few other options as well. So for the show every morning, we're going to choose our most popular option, which is going to be a personal bank statement for 12 months. And this is going to be for a self-employed borrower. So instead of the conventional guidelines where we're going to use their tax returns, we're going to actually use 12 bank statements to then determine a debt to income ratio for that borrower. Many times our self-employed borrowers may be doing write-offs and other things on their taxes where they don't quite qualify, but we can determine their cash flow with their actual bank statements and actual expenses and determine their debt to income ratio using that to hopefully qualify them for more money typically. So these are great options for our borrowers who are maybe looking to qualify for more or maybe don't qualify at all under this certain program they're looking for. So we love to offer these alternative options. Going to be a little higher on the rate, we'll see. But again, this is for a borrower who would not otherwise qualify. So these are solutions to problems, and we love these programs. So right now, the best option it looks like the computer found was a 7% rate for 0.875 in discount points. So again, great option. You saw the conventional was in the 6s, and we can use bank statements and still stay in the low 7s. So some amazing options here. And you'll see there's dozens and dozens of different options. In the non-QM world, there's all kinds of different programs, and a lot of these have flexibility for other items, such as maybe a bankruptcy or a foreclosure and other things that would be outside of the conventional guidelines. but some of those ones that do allow that flexibility might be something in the higher rate as you see here. So please get with our team. We can navigate these hundreds of different options in order to use alternative documentation and find the best program that fits for you. Now let's go into the next segment here. We always want to check out our investment property purchases as well. We love to work with investors at the Mortgage Calculator. So let's pull up our occupancy to investment property and check out our options there. We'll pull up an 80 LTV again, 20% down payment for investment. Great options for our investors out there. One discount point will be our target. And we're going to compare our conforming conventional with our non-QM. FHA, VA, USDA, those are not eligible for investment properties. So we're going to compare conventional with our non-QM options. So conventional, 30-year fixed, investment property, everything else is going to stay the same as all our other examples. And we'll see what our conventional pulls up here. And keep in mind, the GSEs, Fannie Mae, Freddie Mac, have added basically a penalty, a loan level price adjustment to investment properties. So while we see some great rates in the sixes, looks like the best option here that the computer came up with was 6.75 rate for 3.125 discount points and buy down. So because of those additional costs that the GSEs have added, we typically don't see an option for a par rate or no discount points, or even the one discount point that we ask the computer to try to find. So a lot of times our investors that do qualify for full doc conforming do ask us to find other options, even if they do qualify, because they want to save money, right? So this is a lot of discount points. We want to propose alternative solutions for our investors who may be okay with going up in rate in order to reduce the discount point. So unfortunately, conventional, we can't really go up in rate. See the lowest discount point option that we can find here. Looks like this one. 7.375 rate for 2.625 in discount points. Still, a lot of our investors would like to go higher if the property cash flows. And that's where we love to offer our non-QM expanded guideline solutions. So let's pull this up again for our last example for today on the live rates. We'll pull up investment property. We'll pull up expanded guidelines, aka non-QM, and everything else will stay the same. But now we have two other options to select. So we can select our income verification. We can go to investor DSCR, our most popular option for investment properties, because it does not actually require any income verification. It's going to use the property rent income in order to offset the PITIA, the expenses of the property, and that's going to determine the debt service coverage ratio. So typically, as long as the property will cover its own expenses, we can typically do that loan without any employment or income verification from the borrower. This is our prepayment penalty option on a non-owner occupied non-QM program. We're typically always going to have a prepayment penalty. That's pretty standard. Of course, we can have a no prepayment penalty option. It's just going to be a little more expensive. 3 years, pretty standard. We can have a 5-year to save a little bit of money, but for all of our examples, we always use 3-year. That's typically standard for our non-QM programs. And let's check out our amazing DSCR options this morning. So it looks like the best option the computer found here this morning is at 8.375 rate, so a little bit higher than conventional, obviously. But notice the discount points, 0.850 on the discount points, so it saves our investors money out of pocket. So investors love to have these options, and most importantly, less documentation, and allows them to do multiple DSCR loans for multiple purchases or multiple refis. A lot of our investors are doing multiple refis to do multiple purchases at the same time, and that's really what the DSCR options afford us, so that we can quickly expand portfolios for our investors. So there's dozens of DSCR programs here as well. For example, some of these at a little higher rate might allow us to use short-term rental income, another common request that we have. So please get with our team. They can navigate through these hundreds of different DSCR options we have, and we have some amazing rates and also some amazing programs that do allow some flexibility there. So please get with our team. We would love to quote those for you. Now, let me get into our next segment here and introduce our topic for today for our deep dive. And that today is going to be our hard money mortgage loans. So I'm going to pass this over to Jose Gonzalez, our sales manager with 27 years of experience, both as a loan officer and a realtor. So he has a lot of perspective here on both sides of the deal, and can explain a little bit more about what the misconceptions may be about the hard money loans that we love to do. So why don't you go ahead and take over, Jose? And when you're ready, I'll go ahead and share your live example with the live rates. Just let me know.
All right. How's everybody doing this morning? Thank you for joining us with a daily mortgage rates with the mortgage calculator. Now, hard money is a phrase that gets thrown around a lot. And actually, a lot of people who are not directly involved with buying these types of properties that would use hard money really have no idea what it is. But what it's come to mean is non-traditional and in some cases non-institutional financing that has basically very limited or no guidelines. It's purely asset based, and in this case, asset I'm talking about is the collateral, not the assets that you may own, like in the bank, stuff like that. And so it's not an asset depletion or asset utilization option. It is a collateral based option. So there's a lot of reasons why you would use hard money, but typically the main one is the property has issues, combined with the borrower may have issues, combined with usually we need to close yesterday. We need hard money. We can't be bogged down with tedious underwriting conditions. Need a streamlined approach. So then that's where we're usually going to go with hard money. However, as I'll explain a little bit at the end, and as you already know, there's other reasons people use hard money. Actually, I'll get into it right now. Sometimes they use hard money because they don't know other options exist for borrowers with no income documentation, like the DSCR option, right? That's usually our hard money killer. That's how we like to think of the DSCR. But getting back to our hard money scenario here, I'd like to share a nice little twist that I have here, because we're always looking for ways to add value to the transactions as MLO. That's where we come in and we have on our consultant hat and we try to really provide the best solution to our investor in this case, because hard money loans are only for investment properties. Prior to the Dodd-Frank Act, which stated that basically you had to have some type of income verification for primary and second homes. So that meant that basically, if you're going to use hard money, it has to be an investment property. So remember, hard money is only for non-owner occupied properties. So we try to always try to find more interesting ways to implement our solutions. And here's a really good one, which combines a couple of needs for that borrower. Now, typically, the hard money type properties, since they do usually tend to have some type of a condition issue, property condition issue, which may render institutional or traditional, quote unquote. Because remember, our DSCR loans, we don't consider them traditional, but they are institutional loans. So where something like that may not be possible, and then we have our hard money option here with limited review, but also adding on a couple of the other needs that you're usually going to find where that the hard money loan needs, which is no FICO score requirement with hard money, and a flexible lending where we can actually go here up to 80%. Oh, and let me throw in there before I go deep into this, no income requirements either, no DSCR requirements, none of that. This is, pure collateral based, right? They do look at the credit score a little bit, just more than anything else. If you're trying to size up a deal that may fall out of the parameters, or if you're trying to take it to the limit on the LTV, your borrower has to have, decent credit. They're probably not going to give you the maximum they're going to do if your borrower has a 480 credit score. They may do a little bit of an adjustment there. But in a scenario here, we did the scenario with 550 credit score, and they will lend up to 80% of the purchase price, as long as it is that the loan amount is no more than 60% of the ARV. So, they do their little BPOs because it's not like a full appraisal that gets done on this. And the BPO will include some type of an ARV calculation depending on the amount of rehab that you feel that the property needs and what you're going to do. And if they feel it's going to be that much prettier and you're getting it at a below market price because of the issues with the property, then, typically, most investors do, you'll be able to get 80%, 20% down hard money. Now, if you have a scenario, and here the rate, obviously this is no holds barred, so the rate is going to be a little bit higher, but keep in mind that the prime rate is somewhere in the mid sevens right now. I think 7.25, 7.5, something like that. So they got to add a little bit of margin here because they usually borrow theoretically at the prime rate unless they have some HELOC on the side there that's some kind of a below prime and all that kind of stuff, obviously, but they need to make a margin. So we're looking at 13.99 here, and we are looking at 3 points there uh, to buy down that rate. So not a bad deal here due to the 80% financing. Keep this in mind. This is hard money here. So now when you have your transactional hard money where there is no rehab component, and it is going to be a little bit different. And mind you, there was a typo on the other one there. We had to throw the compensation, which we did throw it into this rate right here. So here, points and comp is all rolled into one amount. And this is hard money with no rehab component, or it could have minimal rehab component, but you're looking at a scenario where somebody really needs to sell. They need to close tomorrow. You don't have time to mess around with it. You're buying the property really below market. You don't want to lose the deal. No time to waste. So you're going to go into this kind of a transaction. And that's it. If you're going to make $200,000 because you can close in 3 days, it's worth it to you to close on it and then, execute your follow-up exit strategy at some point in the near future. Because in all these hard money deals, just like in a fix and flip deal, you don't go in there not knowing what you're going to do when the loan is about to expire. You have to have your exit strategy, which is either going to be one, sell the property, right? It's a true then flip, or two, refinance the property into an investment property loan, such as a DSCR or other applicable options. Maybe by that time they got income, they can provide bank statements, you can do something other than a DSCR loan. That's fine. We have many options, but a lot of the investors, especially the ones that have multiple properties, like 20, 30 properties, don't really want to be messing with the something other than a DSCR loan. So again, here's our no rehab hard money. So now we're going to add another little twist to here. Um, Assuming you have your borrower that, let's say, has at least a 650 credit score and maybe doesn't necessarily need the hard money, but still wants more flexible underwriting, still wants to be able to close quick, doesn't want to be bogged down with a lot of details. We do have a bridge loan. Oh, and doesn't necessarily want a short-term loan. They want something that actually has a 30-year term, but is underwritten like hard money, like a bridge loan. So we do have options like that. This is a low FICO, so it's truly not a bridge loan. We're just calling it bridge loan because it's the ease to get into it. So this one does have a minimum 650 credit score, does go up to 75% loan to value, and does give a 30-year fully amortizing term. Does have a 5-year interest only period. Does have a 5-year prepay as well, which is a declining prepay, 54321. So that's a pretty good deal. So again, rate's pretty good, 11.24. It's only like 3-4 points above prime. Really good option for a flexible underwriting, 75% LTV, and still pretty low score. And again, this is no income, no nothing, no DSCR either. This is why we're saying the flexible underwriting similar to hard money. Obviously, this is a property that doesn't need rehab to be able to close. Now, if you have a higher FICO score individual that still wants the high LTV and limited, flexible underwriting, no income, no nothing, no DSCR, this is a 9.99% rate. Now, this is again 30-year product, is fully amortizing. You do have a 5-year interest only option. There is a 5-year prepayment penalty. This option is with an 800 credit score. So you see excellent rate, 9.99 and a 75% LTV. So now this could almost be considered a DSCR fallout. This is in between hard money and DSCR. Is this option gives your more conservative investors time to think about what they're going to do and not be rushed into do I want to sell, do I need to sell now or need to refinance because my 12-month or 18-month loan is due and now I got to do more transaction expenses. And with the 9.99 rate still does give options, because that fee that you see there is all in. That includes any buy down, that includes any commissions and everything due on this $375,000 loan. So home run here for our investors. So again, at the Mortgage Calculator, we are about solutions. We are about consulting our prospects, our borrowers, training our MLOs to be consultants and to add value to the transaction so that it's a win-win situation for everybody, especially in this real competitive environment where borrowers are looking to be able to close. Everybody wants a competitive advantage. That's why right now the professionals are the ones that are getting the business, because you're not going to entrust the largest financial transaction of your life with just somebody who just got into the business and has no support from his team or anything like that. You want to deal with loan consultants that are going to take you by the hand, guide your transaction, and make sure that your deal closes on time and as promised with the terms and conditions that were offered.
All right. Well, thank you, sir. Let's go ahead and, I guess I'll put you back on the other screen there.
They got covered up there.
Yeah.
All right. Well, thank you.
Thank you. Close this out and tell everybody how they can connect with our team.
Yeah, absolutely. Yeah, so thank you, Jose and Nick. That was great. So we have over 350 loan officers from all across the country that can help you out with all these type of loans. Now, if one of our loan officers shared this with you, maybe you're already talking to one of our loan officers, that's great. Definitely connect with them. They can get you a quote, a specific quote, within just a few minutes on everything from conventional to even what Jose was showing you there, through the DSCR programs all the way to the hard money and all that kind of good stuff. So definitely connect with one of our loan officers if you're already speaking to them. If not, we can connect you with one. Just visit our website, themortgagecalculator.com, which is right here, like covering up my face. And you could also email us info@themortgagecalculator.com. We do this show every weekday at 11 a.m. Eastern, where we go through the current rates for that day, and then we do a deep dive on a specific subject, just like we did today with the hard money loans. So definitely tune in every day so you can see what we're going to do that day for the deep dive and see the current rates. I appreciate everybody tuning in. Hopefully we will see you all tomorrow. Thank you, Nick and Jose. Everybody take care.
Thank you, everybody. Have a great day.
Thanks, everybody.